Joining us now is Sylvia Jablonski, CEO and Chief Investment Officer at Defiance ETFs. Sylvia, what do you make of today, and how worried are you, if at all, about the solidness of the banking industry?
Good morning, Melissa. Well, I think you said it well about an hour ago that what we're worried about is we don't know what we don't know. So I think that we're in this situation where the market is going to be volatile. There's going to be a lot of uncertainty until U.S. authorities can essentially give us some confidence or shore up some confidence along with European officials that the banking system is stable. I think that, there are too many outliers there and we just don't know where we're at. And in the near term, that's certainly going to affect stock prices.
And we're certainly seeing that in terms of where we are seeing the moves. We're seeing a move higher sharply in the dollar. We're seeing a move to treasuries with the 10-year yield now below 3.5%, the 2-year below 4%. Sylvia, is that going to be the name of the game, at least for now, safety?
I think safety or sidelines are going to be the name of the game for the next couple of days. I think if we get, positive news around the banking sector being stable, I think if we get a Fed chair that maybe talks about pausing and brings down the hawkish rhetoric and kind of we feel like a Fed put might come, then I think that turns things around. But, remember, there are still companies out there that are well capitalized. There are a lot of, big types of tech stocks like Apple, Microsoft, Amazon, Google. They actually have a lot of cash on their balance sheet, and they were the most unfavorable plays and most highly impacted by rates. So if we think about rates easing and we think about those companies having strong balance sheets, there are places for investors to look. But, you certainly have to have the stomach for it and understand that risk is likely to the downside in the near term.
What's interesting about this move in treasuries this morning is that with yields coming down, it actually makes the stocks versus bond question maybe a little bit more difficult in some ways because, before I think you ran into a lot of equity people who said, bonds actually because of the yields. But now with yields below, 3.5 on the 10-year, maybe it's not so clear anymore.
Yeah, I think it's not so clear anymore. And what's also not so clear, though, is that you haven't really seen equities really rally off of that news in the last couple of days, last Thursday and Friday either. So the systematic risk that we have, or potential systematic risk that we have hanging over our heads with banking, I think is just kind of throwing everything off kilter. But to your point, I do think that equities start to look a little more attractive at these levels.